Radhika Rao, Senior Economist and Executive Director, DBS Bank, joining in this morning. Ms. Rao, thank you so much for your time. How do you look at this new series coming in? And is CPI today, in a few days from now, you're going to have a new GDP series as well?
Morning, Tamanna. Yes, certainly, I think inflation numbers are usually garner a lot of interest, and I think much more today, because we're going to have, like your colleague just mentioned, there's going to be a new rebased as well as a revised series, right? So not only are we moving the base here, making it more current, but the number of item representation is going to increase, and in fact, if you see the rural and the urban, even the sample size is going to increase. So essentially, it's a huge methodological overhaul as well. So if you look at the numbers, you're going to have about a 9 percentage point decrease in food and about a 10 percentage point increase in core. So in all this while we've been talking about where core inflation is, it will become much more representative now, because we will know outside of food and fuel what is the household facing in terms of price pressures. So certainly very important. And you just mentioned about the GDP as well. I think that's where there's going to be a rebasing exercise. Numbers come out, I think, about 27th February. So we are going to see a new set of numbers. And there too, I think, based on the last rebasement exercise, what you had seen is the GVA series was announced. This was the last overhaul. This time around, I think there might be a slight upside bias to the GDP numbers per se. But on the inflation front as well, I think similar things are likely to pay out. I think April to December of last year, they will give backdated data that will look, I think, about 40 to 50 basis point higher. And January, if I calculate old series, it's about 2.4, 2.5%. The new series could be, again, 40 to 50 basis point higher.
Radhika, in some sense, good morning, Neeraj here. In some sense, this seems like a more realistic inflation peg, because for years now, as we've anchored and as we've spoken, the comments were that WPI never quite captured what's happening at the consumer end, and CPI was too skewed towards the consumer side and not quite capturing what's happening at the manufacturer's end. Does this kind of blend the two a bit better?
Hi, Neeraj. Yeah, absolutely. And if we remember, what was the major criticism about WPI was that it didn't include services, and that's when we had to shift to a retail inflation-based gauge, and then CPI inflation became the primary central bank objective. So I would say, to some extent, that wedge will still be there between where WPI and CPI are, because WPI by nature tends to have a more, I would say, commodity weightage. So when, say, commodity prices swing a lot, you will see a bigger swing in WPI inflation as compared to CPI inflation, which captures essentially the last mile price move. And so, besides all the methodological changes that we spoke about, I think there is also going to be more, and one of the criticisms about, I would say, inflation and why it used to be very volatile is that compared to the EM markets, the food weightage was very high in India's case, upwards of 40 to 3% of inflation. So which is very high. More, especially on the urban side of the economy, more and more services is being consumed. So it's certainly much more representative now. It is already a good representation. I think it's going to become even better, keeping the time that has passed in terms of the consumption pattern. So I would say, for policy as well, this would be a much more important gauge to look at. And the central bank already did not provide a full year forecast when they met in last week, because they wanted to wait and see what happens with the numbers. And now that if the series is out, I guess at the next review, they would reveal their annual forecast as well.
So, Radhika, just very simple question. What happens to the CPI number that we're seeing currently in the range of between 2.5%? And, we always report it's well below the central bank's area of comfort or range of comfort. Do we dramatically see that number change after today? What actually happens?
No, very true. So the new numbers, what they do is typically they will give you, so January 2026 will be out. I think data from January 2025 will also be provided, because you need some amount of backdated numbers. And then there'll be a linking factor to take it back to the older series, right? So we have to adjust the older series basis what are the current weights. I think the first takeaway will be that inflation broadly will look higher. Now, I think the important point to note here is we are coming off a year where food disinflation was very high, right? We've had a series low in quite a few of the months. So overall, we would see an upward increase in inflation on average. But that again does not and will not, I think, affect the policy path, because inflation, even if it goes up, what we do is we go from the lower range of the RBI target to lower, I would say, average or lower band of the RBI target. So instead of 2%, we'll be at about 2.5 to 0.8%. So that's how much of the increase you're going to see on an annual level. Not very big at all. I don't think that it really changes the central bank's narrative, because this set of data is what is backward looking. What the RBI is focused on is what's going to happen going ahead. And for the year ahead, inflation is likely to anyway pick up because we're coming off very adverse base effects. So I think 4.4%, 4.2% is a kind of an average that you would see over the next 12 months, especially for fiscal 27.
Okay, so that puts things in perspective. The number doesn't change dramatically. It doesn't dramatically change any decision the RBI would have taken. But yes, it's now more reflective of what's happening in our world today versus 2012. Thank you so much, Radhika, for speaking with us. Absolute pleasure.